Federal Reserve's latest round of stimulus. One more reason. My next guest says the markets are distorted. Known Fed critic Jim Grant once again slamming the Fed for its low interest rate policy and what he calls nonstop chronic interventions. Mr. Grant is founder and editor of Grant's Interest Rate Observer. He joins us right now for an exclusive interview. Once again, Jim, it's always wonderful to have you on the program.
Well, thank you, Maria. Nice to be here.
Thank you so much for joining us. Okay, so you've talked a lot about the unintended consequences of all of this stimulus. Now we're QE forever. Give us those unintended consequences.
There are always consequences for interventions, but those consequences are not always the ones they intend. In the case at hand, Chairman Bernanke in Jackson Hole a few weeks ago enumerated only four possible pitfalls of what they are up to. There are 400 million possible pitfalls, including things far, wide, and near. Apart from the starvation of the savers and the subsidy of the speculators, there is, for example, the levitation of real estate values in Hong Kong, the Hong Kong dollar being harnessed to the American dollar, right? That's the way the Hong Kong Monetary Authority works. The currency is pegged to the dollar. So they import our interest rates, so up go Hong Kong real estate prices. That is a distant unintended consequence, perhaps, of these radical interventions. The most important thing to know about them is that, to quote the chairman himself, as he said, we are learning by doing. This is an experiment, and we, Maria, are Labrats in the financial markets of the world.
It's a science project.
One can imagine all manner of things coming to pass. In the junk bond market, yields hit recorded lows on the Standard & Poor's Liquid Junk Bond Index. It closed at 6.25 the other day. Now, this is the high yield market without the yield. You shouldn't have this.
Yeah, unbelievable.
There is a great stampede into corporate debt. There is a great stampede into speculative grade debt by people who are not getting, I think, paid for the risk.
They're looking for yield.
The credit markets, when they are left unmanipulated, convey information, right? A struggling issuer will pay more than a sound issuer because you can read the financials, and that is priced in the marketplace. When there is a stampede for yield on, the credit markets really convey no credit information except for the important piece of information, the one and only important. This is what they want to have it be priced at.
Let me ask you about the implications you're talking about long-term implications. The implications to a saver.
Well, the implications are immediate.
That's what I'm saying. There are some very short-term implications as well.
Yeah, if you are saving and you are confronting 0%, your options are altogether unpalatable. And, they're the options the government presents you. I heard a former Fed guy, a Fed alumnus the other day, castigate Mitt Romney for daring to challenge the independence of the Fed. Who said the Fed was the fourth branch of government? These guys are answerable to Congress, right? Congress, right, under the Constitution, has the power to coin money and regulate the value thereof. Where do these guys get off?
And yet, the Congress is not doing anything in terms of their own fiscal policy.
They're on vacation, right?
They're on vacation, exactly. What is the best way to invest around these realities that we face? We recognize that the Fed keeps bailing everybody out, and we recognize that this is going to be the case until 2015. So how do I make money on this story?
I think you have to look for a margin of safety in what you do. For example, we have written favorably recently about General Motors. General Motors was trading, at 6.5 times or so the 2013 estimate. It's got all manner of hair on it, but beneath the hair there is a sound post-bankruptcy balance sheet, we think even adjusted for immediate pension difficulties. There is the fact that the American odometer is at near record highs. People are driving old cars. We think GM is in a pretty good place with respect to its product. And the stock is cheap on the numbers. So what we think one ought to do is to look for a margin of safety in equity-like investments that will stand to benefit from these monetary exertions. But, we are all living in a world of speculation and a world of manipulation. It's not so easy, but there are things to do.
You show your latest cartoon, darling, you're so quantitative.
Yes. Yeah, well, not everyone hates this policy. This is a policy for Greenwich, Connecticut, right? It's great if you can fund at 0%, if you are on the inside and know when they are going to do what they're going to do. It's great. Your asset prices levitate. It's good for commercial real estate, probably. It's good for a lot of things, but we don't know altogether what it's bad for. We have a general sense, but we'll find out more in about 3 years.
When do you think the Fed should begin to start raising interest rates?
2 years ago.
2 years ago.
I mean, I think that rates are prices, right? And price control is a demonstrated failure as a public policy. Chairman Bernanke himself castigated the Nixon administration for imposing price controls in 1971. This is during his lectures in March to the students of George Washington University. He was right. Price control fails. What he's doing is controlling prices. He's suppressing interest rates, muscling around the yield curve, and through this pretty phrase, let's see, what is it? The investment portfolio balance channel or some such. He is attempting to press to lift equity markets because that will, he says, induce economic growth. Shouldn't equity markets respond or discount wholesome growth rather than be muscled higher by central banks?
Right.
The answer to that rhetorical question is
well, you're
yes.
a free markets guy, and I agree. You want the markets to work the way the markets ought to work. But knowing what we know, is there any reason to believe that you want to get in front of this train that is the stock market?
Well, I think this is where security analysis comes in. I think it's where an investment in gold and or silver comes in. Central banks around the world are bound and determined, they make no bones about it, either through actions or words to debase their currencies. Well, they're telling us.
How high can gold go in this scenario?
The nice thing about gold is that it's got no PE multiple. I mean, there's no telling. Gold is a because it earns and yields nothing. Gold is a speculation on an anticipated macroeconomic outcome. That macroeconomic outcome being the systematic debasement of currencies by central banks. They've done QE3, right? The economy appears not to be in the best of health. Why wouldn't they do QE4? What intellectual argument do they have against doing it again and again and again? So that's one of the risks, right?
Well, it's open-ended already, so maybe they don't even need it because we know it's open-ended.
They can save the paper in the press release, right?
Yeah.
Just keep doing it.
And what's your take on real estate? I mean, you mentioned real estate, one of the unintended consequences in real estate in Hong Kong because of the dollar relationship. But, there is an argument to be made that given the QE forever, that you want to be buying hard assets like a gold, like real estate.
Yeah, I think it depends how it's valued. In some markets in this country, you can, for example, buy houses at less than the replacement cost, and you can finance them at all-time, or certainly generational low interest rates in the mortgage market. That's not a bad way to hedge against the debasement of the currency. I
know Bernanke knows that you have been so critical. I mean, what is his answer to you when you raise these points?
We don't talk anymore.
Jim, good to have you on the program.
Okay, nice
Thank you so
much.
Jim Grant joining us.